Welcome to the Deep Dive. We're digging into those dense reports to pull out the insights that matter for you. Today, we're jumping back 3 decades, actually. We're looking at the 1993 Shareholders letter from Fairfax Financial, a real landmark document.
Oh, absolutely. It's a huge moment for them. Management kicked it off saying, wow, what a year. And, they really weren't kidding. They flat out called 1993 the best year they'd had since starting back in, September '85?
Yeah, and our mission today is to figure out how they pulled that off. What can we learn from a company that seems to run on this almost spontaneous strategy? Because the headline numbers, they're just off the charts. Net income hit a record $33.3 million. That's more than triple the year before.
And that just poured straight into shareholder value. You look at book value per share up 48% to $35.13. And the stock price, 145% jump in just 12 months. Incredible.
I love the honesty, too. They actually admitted they'd have to work hard to achieve our last objective, balanced reporting. Just too much good news. Huh. Right. You mentioned strategy, though, and that takes us straight to the big event of '93. How does this idea of long-term compounding fit with that philosophy they kept quoting from '87? We have no long-term plans other than to react to opportunities on a day-by-day basis. Doesn't quite add up, does it?
Well, that's the fascinating part, isn't it? That sort of tension between reacting quickly and sticking to this disciplined goal.
Yeah.
And that day-by-day opportunity, it popped up as the acquisition of Ranger Insurance, a company they barely even knew about before the last few months in '93.
That's amazing. So they bought Ranger, this niche insurance company, for about US $125 million, paying a bit of a premium over its US $105 million book value. But what stands out to me is how they structured it. The seller gave a US $20 million reserve indemnity, and Fairfax made sure that was fully backed by real estate. So quick, yes, but also quite careful.
Very shrewd. And buying Ranger meant they needed cash, a lot of it. So they pulled off this huge capital raise, two big financings at the same time, enough to pay for Ranger and pay off all their existing bank debt. That was a real power move, a statement about their financial strength.
Okay, so walk us through that. On the equity side, 2 million treasury shares at $55 each. That increased the share count by a third, 33%. Management seemed okay with issuing stock, though.
Yeah, but only under specific conditions. Their line was clear. We will ensure that we get as much value as we give. They weren't just going to dilute shareholders without getting something really solid in return.
Got it. And then the debt side, their first public debt offering ever.
That's right. A US $100 million 10-year debenture fixed at 7.75%. Huge step for them. But the really interesting bit is the talk around the credit rating. They ended up paying 210 basis points, that's 2.1 percentage points, over comparable U.S. Treasury bonds at the time.
Whoa, wait, 2.1% over treasuries. The rating agencies S&P, Duff & Phelps, DBRS gave them a BBB rating. That implies quite a bit of risk, right? But management sort of brushed it off, saying they run the company to much higher standards. Was that just confidence, or?
Mostly confidence, I'd say. But, confidence backed by their track record, or at least their intentions. They basically used the letter to tell those debt investors, look, we know we're better than BBB. Just watch us prove it. But regardless of the rating debate, they got what they wanted. Incredible financial flexibility. They wiped out all their bank debt, ended 1993 with $75 million in unused, committed, long-term bank lines just sitting there.
That kind of liquidity is gold, especially at insurance. And the payoff for shareholders. You look at the investments working per share, it jumped from about $65 to $107 after all these moves. That's a massive boost in potential earning power per share almost overnight.
Exactly. Plus, Ranger helped with diversification. Suddenly, almost two-thirds of their expected insurance business for '94 was going to be in the U.S. market. Better balance against their Canadian operations.
Okay, that capital injection is one thing, but were the underlying businesses, the actual insurance companies, healthy enough to put that money to work effectively? How did the subsidiaries perform in '93?
Yeah, good question. Operationally, things looked much, much better overall. The combined ratio, losses plus expenses as a percentage of premiums came in at 99% for the year.
And let's just pause on that 99%. For anyone listening, a combined ratio under 100% means the insurance operations themselves are profitable before you even count investment income. Hitting 99% was huge. It meant they finally reached their long-term goal of 100% or less, a massive turnaround from the 114% they had in '92.
Absolutely, and a couple of subsidiaries really shone. Commonwealth, for example, a record year for them, 92% combined ratio. Just think, the year before, thanks to Hurricane Andrew, they were at 122%. Huge recovery. Earned them an A rating upgrade from AM Best, too.
Impressive. And Federated.
Federated was solid. An excellent 98% combined ratio. They were just dominating their niches, like farm equipment dealers, tire dealers. That focus was really working. They earned something like a 36% return just that year on what Fairfax paid for them back in 1990.
Wow. Okay, but the letter promised balanced reporting, so there must have been some rough
Oh,
spots.
definitely. They pointed straight at Markle. Another difficult year, they called it, an unacceptable combined ratio of 112%. And it was even worse in their long-haul trucking business, 115%.
Ouch, 115%. Losing 15 cents on every premium dollar before investments.
In a year when the others did so well, why was Markle struggling so much? Were they maybe being a bit too patient? Well, management admitted it was tough. They said they were working hard on it, but also pointed to intense competition in that sector. It shows you, even in a banner year, there are always parts of the business under pressure. They also mentioned the claims adjusting arm. Morden and Hellwig had another poor and very frustrating year.
Okay, so a bit of a mixed bag operationally, but overall improvement. Let's switch gears to the investment side. That seemed to be the real rocket fuel for the record income. They called 1993 the best year we have ever had for investments. Quite a swing from 1992, which was apparently one of their worst. Talk
Yeah.
about volatile.
Yeah, their investment managers, Hamlin Watsa Investment Counsel, HWIC, really showed their long-term value. Just look at their U.S. equity performance. Over 10 years, they delivered an annualized return of 19.6%. The S&P 500 over that same period, 15.6%. Consistent outperformance.
And 93 was harvest time. They took profits. Realized gains hit $27.8 million, driven by selling big positions in names like Lone Star Tech, Mackenzie Financial, and several big Canadian banks. They sold off, like 60% of their common stocks, capturing those high market prices.
hmm And this really gets to the heart of their philosophy in the letter. Management specifically tells you, the reader, don't get particularly excited about the short-term paper gains. They had $11.4 million in unrealized gains at year-end, but they stressed, realized gains or losses are what count over the long term. If you haven't banked it, it doesn't really count yet.
They saw the market conditions clearly, too, noted that stocks in Canada and the U.S. were way up thanks to low inflation, low interest rates, and they used that great phrase, mutual fund mania prevails.
It's almost funny how that comment from 30 years ago sounds exactly like market commentary you hear today, right?
Yeah.
About potential bubbles or euphoria.
It really does. And that kind of skeptical view, that awareness of potential froth, leads straight into what I think is the real aha moment in their risk management approach. Because they're always thinking about the downside, Fairfax uses this mandatory monthly stress test on everything. Okay, let's break down that test because it sounds pretty brutal. Every single month, they model a simultaneous crash. 50% drop in common stocks, 30% in preferreds, and 20% in bonds. That's like modeling a sudden, catastrophic market meltdown.
Exactly. It's incredibly severe. And here's the key takeaway from the letter. As of the end of 1993, even after applying that brutal test, their insurance companies would still have met all their statutory capital requirements.
Right. And just so everyone understands, meeting statutory capital requirements means even after that nightmare 50-30-20 crash scenario, the company is still solvent, still legally allowed to operate its insurance business. Their absolute top priority isn't squeezing out the last drop of investment return. It's making sure the company survives anything. Capital preservation above all. That's risk management personified.
Couldn't say it better myself. It guarantees that the investment portfolio, however well or poorly it does month to month, never puts the core insurance operations at risk.
So let's try to wrap this up. What's the big picture here for you, the listener? We've seen these aggressive, almost ad hoc moves like buying Ranger, the huge simultaneous capital raise, a fantastic investment year, but all of it wrapped in this incredibly cautious, downside-obsessed risk management.
Well, it means that while 1993 was spectacular, the real story is the long game, the compounding. From 85 to 93, book value grew at an insane 42.4% per year. Though, to be fair, management immediately said that rate cannot be repeated. More realistically, their 8-year average return on equity was 21.3%, just slightly ahead of their long-term target of 20%.
And that 20% ROE target seems to be their North Star, the foundation they keep building on. But even after celebrating this record year, they were incredibly upfront about the risks ahead going into 1994.
Yeah, they didn't sugarcoat it. They listed ongoing intense competition. Markle's problems weren't solved overnight. Catastrophe risk, they specifically mentioned the big California earthquake that had just happened in January '94, warning that, the big one will impact our earnings significantly. And then there's the long shadow of legacy claims, mentioning asbestos specifically.
Right, that fundamental insurance risk where they said something from the past can come to haunt you years later.
Mm-hmm. And finally, they flagged the very thing that helped them in '93, the strong stock market. They noted if markets tanked, it would hit 1994 earnings. They ended by saying business is always uncertain and unpredictable. Very grounded.
So it leaves us with this core tension, doesn't it? This defining characteristic of Fairfax. They operate by reacting to opportunities on a day-by-day basis, like snapping up Ranger, raising capital on the fly, but somehow they maintain this almost religious discipline about the long term, hitting that 20% ROE target, running those brutal stress tests month after month. So for you listening, maybe the final thought is this. How do you build a system, a company culture, that allows for that kind of rapid, opportunistic action, while also enforcing an unwavering disciplined focus on long-term survival and value creation? Getting that balance right, that seems to be the enduring puzzle and the genius behind Fairfax's strategy.